Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of business and finance to see if companies are really as shiny as they seem, especially after this last report from Air T Incorporated. This company does a lot of things in the aviation world, from air cargo to aircraft parts and even digital solutions. They just dropped their latest quarterly report, and let's just say it is a mixed bag. Folks, this filing is packed with numbers, but we're going to cut through the noise and find the real story. Focusing on what matters most to you if you want to stay ahead of the curve on corporate finances and understand what is really going on behind the scenes, make sure you hit that subscribe button and ring the notification bell. And if you want to chat more about these filings and connect with other finance enthusiasts, join our Discord community linked in the description below. Okay, so first up, let us look at the big picture revenue. For the 3 months ending the 31st of December 2025, their total revenue came in at about $71.1 million. That is a dip from the same time last year when they were pulling in nearly $78 million. That drop of about 8.7% is definitely something to note. Now, where did that revenue loss mainly come from? Well, the commercial aircraft engines and parts segment took a pretty big hit. Revenue there dropped by a massive 42%. That is a huge chunk of business potentially disappearing, or at least shrinking significantly. The company says this is due to a decline in component sales because of aging inventory and increased competition. They are working on rebuilding inventory, but losing over a third of your revenue in a segment is a big deal. On the flip side, they picked up a new segment, the regional airline business, thanks to acquiring Rex Holdings Limited. This brought in about $5.2 million in revenue for just a couple of weeks of operations in the quarter. That is a 100% increase in that category, obviously, since it was zero before. Now, about expenses, consolidated operating expenses for the 3-month period decreased by about 6%. That sounds good, but let's break it down by segment. The commercial aircraft engines and parts segment also saw its expenses drop significantly by 41%, which makes sense since their revenue dropped by 42%. It seems like they are cutting costs alongside the revenue hit in that area. But then you have the new regional airline segment, which racked up $5.5 million in operating expenses in just those 2 weeks. They say this is due to fixed costs and integration expenses. It is understandable for a new acquisition, but it still adds to the overall cost picture. Speaking of costs, general and administrative expenses overall went up by 17%. That is a significant increase, and the company points to acquisition, related costs for the Rex deal, and higher payroll. So while some operating expenses went down, the behind-the-scenes costs for running the company are growing. Let's talk about what happens outside of the core business operations. Interestingly, their income from investments in other companies shot up dramatically. Last year, they were sitting at about $661,000, but this year it jumped to over $4.2 million. That is a massive $3.6 million increase. This is a big deal because it helped offset some of the losses in their main operations. Their interest expense also stayed pretty stable, around $2.5 to $2.3 million, showing they're managing their debt payments consistently. So with all of that, what is the bottom line for Air T Incorporated themselves? For the 3 months ending the 31st of December 2025, the company reported a net loss attributable to stockholders of about $2.45 million. That is worse than the same quarter last year when the loss was about $1.3 million. This means for every share of stock, you lost about 91 cents. That is a pretty stark contrast to the same period in 2024 when they actually made about 32 cents per S-share. This shows a definite downturn in profitability for the most recent quarter. Now, let's peek at the company's financial health. Their total assets have swelled significantly from about $173.7 million in March 2025 to a huge $381.7 million by December 2025. A big reason for this massive jump is the Rex acquisition, which brought in a lot of new assets. But with those new assets comes new debt. Their total liabilities almost doubled, going from about $168 million to over $375 million. Again, the Rex acquisition is a major factor here, as they assumed a lot of debt from that company. One really interesting thing here is this deferred credit for a preliminary bargain purchase gain of nearly $96 million. This happens when you acquire a company for less than the fair value of its net assets, which is often the case in distressed situations like Rex's voluntary administration. It sounds like a big win on paper, but the accounting for it is preliminary and could change. It is a huge number that shows how much they bought Rex for relative to its potential value. And when you put all that together, the company's total equity has actually gone from a deficit of about $1.5 million to a deficit of over $2.1 million. So despite the asset growth, they are still in a negative equity position, meaning their liabilities exceed their assets. Let's see how cash is flowing. For the 9 months ending the 31st of December 2025, they actually used about $25 million in cash from their operations. This is a big swing from the same period last year when they generated almost $20 million in cash from operations. This negative operating cash flow is concerning. A big reason for that cash crunch seems to be inventory. They spent about $12.6 million more on inventory this year compared to last year. This could be related to building up stock for the company's commercial aircraft, engines and parts segment, or perhaps for the new Rex operations. In investing activities, they actually brought in over $6.9 million. This is a positive swing from last year when they spent over $16 million. This cash inflow is primarily from selling 2 aircraft for nearly $20 million. They also received a good chunk of money from their investments in other companies. Financing activities show a massive increase in cash inflow. They brought in over $53 million this year compared to about $8 million last year. This is largely due to taking on more debt, with their term loans and lines of credit seeing significant activity. Clearly, they are relying on borrowing more money to keep things afloat and fund acquisitions. Now, let's touch on the risks. The company is upfront about the challenges, especially with the new Rex acquisition. They're worried about successfully integrating Rex, especially its financial reporting systems. This is always a huge challenge with any acquisition, and for Rex, it is compounded by the fact that it was in voluntary administration in Australia, which is like a formal bankruptcy process. That adds a whole layer of uncertainty regarding existing liabilities and claims. They also highlight that Rex operates in a highly regulated industry and that any compliance failures could seriously hurt their business. This is standard for airlines. But with Rex coming out of administration, the regulatory scrutiny might be even higher. And then there is the accounting mess. They admit their purchase accounting for Rex is preliminary. This means the big bargain purchase gain they've recorded might change, potentially impacting their reported earnings. They're using a lot of estimates and judgments, and if those estimates are off, it could lead to surprises down the line. They're also exposed to currency risk because Rex operates in Australia. Fluctuations in the Australian dollar could impact their reported finances. And finally, the debt. They've taken on a lot of debt with the Rex acquisition, including something called CFA debt, and they might need even more money to keep Rex. Running regional airlines are expensive to operate, and if Rex needs more cash than expected, AirT Incorporated might have trouble finding it. So, what is my take on all this? AirT Incorporated is clearly in a period of significant transformation, driven heavily by the acquisition of Rex Holdings Limited. On the positive side, they are diversifying their business into new areas like regional airlines and digital solutions. The income from their equity method investments has also seen a remarkable jump, which is a good sign that some of their earlier investments are paying off. Plus, they did manage to sell some aircraft, bringing in much needed cash. However, the company is facing some serious headwinds. Their core operations, particularly in commercial aircraft parts, are seeing declining revenues. Their operating cash flow has turned negative, which is always a red flag, and they are increasingly relying on debt to fund their activities and acquisitions. The integration of Rex with its regulatory complexities and preliminary accounting is a massive undertaking fraught with risk. The substantial increase in general and administrative expenses also points to a growing cost of doing business that isn't directly tied to sales. The big opportunity here rests on the Rex acquisition truly becoming a growth engine. If they can successfully integrate Rex, navigate the regulatory landscape, and turn it into a profitable regional airline operation, it could significantly reshape the company's future. The digital solutions segment also shows promise with its growing subscription revenue. The major risks are clear: failure to integrate Rex, unexpected liabilities from the acquisition, the ongoing reliance on debt financing, and the inherent volatility in the aviation industry. The preliminary accounting for the Rex deal is also a point of concern that will need close watching. My conclusion is that AirT Incorporated is making bold moves, but these moves come with significant risk. They've essentially bet big on Rex to turn things around, or at least provide a new path for growth. The next few quarters will be crucial in determining if this high-stakes gamble pays off or adds to their financial challenges. We'll be watching closely to see if they can manage this complex transition and deliver on their diversification strategy. Alright, that is our breakdown of AirT Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.